in the equity index complex. The VIX traded primarily between the two volatilities, 16 and 17, really between this daily 1 and 17, but resting right back here in the middle of the range. And if I show you over here what it looks like, this is your monthly range. So you can see we're right in the middle of this monthly range. Nothing to be fearful of yet. Each time the volatility got above 1661, they sent it back down swiftly. But they wanted the volatility to get a little bit higher to 17 to get the market off of those 6-month ones. And it got up a little higher than I thought it was going to. I was playing around with all of my tails. Um, we can track tails in the platform. And this was 019. So that's not even 2%. It's 019% right there. So not even, it's just 1% off of the 6-month one. So what happens is forgive me for sounding elementary, but we're at the 6-month 1 sigma, the R vol. The H vol was down here. That was the main um, resistance rather. And you see it failed 1, 2, 3, 4, 5, 6 times. And on the 7th day, 8th day, really, the 8th try at it, it finally was able to break it. And we initially went up to a quarterly level, but here we hit the level and we had the open and close. So this morning I hedged it from, going from the open to the close. There was an 8-point difference, and the market actually stalled at 65.90. So I know that little dealer gap works, right? But the market was resilient and broke the dealer gap. So they hedged it to 6,800, which was that call wall that was already there. And what I want you to be, thinking about the way I think about it is you have market makers. When you look at your platform and you look at the volume and the open interest on an option agreement, so we can just pull up Quick Strike and take a look at it real quick. So when we pull up the option and open interest on this, here's the volume, and the open interest was at 6,800. Now it's gone out because this is Mondays, so it's moved out to 6,850. But it was much higher earlier at 6,800. And that call wall is what they leveraged against for the hedge. And I keep telling you this is a hedge from anything above that 6-month one. That's the cheap risk. If you were to go back and look at the premium at the end of the year contract, so let's go see how far we can get. Here's December 31st right here. And right here you can see that it's 89 days to expiration, and 68.25 is the mean, right? So 6,800 is just right there. And that's where they want to, sell the premium at. Is that making sense? So I guess we could theoretically get up to 68.25 um, if this pushes out a little bit further for them to hedge that 6-month one, but they don't use the normal market maker hedge fund levels. If the dealer used the normal market maker hedge fund levels, then we'd all know where their hidden risk is, right? Look, the settlement's the same as the current. Um, you would know all the information about the dealer. The dealer uses its own levels, right? And they were in front of that at 67.82 and also lower. So these are very well tested levels. Um, and you can see it was originally on the H fall, the 14 period, and then it went up to the 1 period. So 68.25, 68.52 is the 14 period 2. So 68.52 would be one more. So that would be theoretically possible also. So between 68.50 and 6,800, they could be hedging that um, risk. But the cheapest risk to sell it was right here at 67.75, 67.70 to 67.82, right where I had my lines. And you saw this morning, let me put this back on a 5-minute chart. 67.74, 67.82. Make these really thick so you can see them. So that you can see that I'm not being delusional. There we go. So that was the first test of it, and the difference between 67.74 and 67.82, this difference right here is 8 points, and 8 points above 67.82 is 67.90, and that was their, oops, right there. This was the line that they were trying to keep you off of. You can see all morning they kept you off of it. And then here, this first attempt was rebuffed solidly. And then when the market finally broke above it, they sent it down, but then they hedged up to 6,800, which I was drawing my little tenth of a percent. They try to get as cheap of risk as possible. Little tenth of a percent hedging was not quite 2% off of that 6-month one level. Um, and then sent it down decisively. We're getting very close to their range. Um, the level is actually 67.82. And so this one right here, the middle one. So this is the one that's controlling this this one right here. Doesn't look like it, but that's their risk line. And I'm going to tell you that you're going to be hard pressed to get market back up there. See, they've already tested it once and sent it down decisively. Right here. Here's your tail. So if they get it above 67.82 next week or the week after, I'm sure we'll go back up at some point, but we should be getting a pullback next week as the market moves from 17 to 19 on the VIX, is my thinking. So if we get above 67.82 or 6,800, be looking for that 68.25, 68.50 level as hard resistance for that pullback. Um, we're not supposed to be getting there until December at this point. Right? This is December for the cheap risk. So if we're going to get a pullback and they want to sell premium, this is the cheapest that they can do it. So they're not in the business to lose money. We are. we lose money all the time, but we're figuring out where they get the most bang for their buck, and I'm telling you, we're sitting on it. So you look at your screens and you tell me. You're probably a lot more knowledgeable in options than I am. So I think that we're going to be getting a pullback from here. It's not going to be anything dramatic. In fact, it's going to be kind of shallow. 17 to 19. I mean, it's just, right there. So we could get there in a couple of days and it'll be over. In fact, we could do nothing over the next couple of days. We could stay flat in here, trading between, these same flat levels without selling off yet. Powell is going to be speaking on Wednesday, right? We have an FOMC meeting. I was trying to see if there was a rate decision on it, on this coming one. It's next Wednesday. No, just their meeting notes. So let's go back to Quick Strike and go over to the Fed Watch tool. It's October 29th, Fed meeting. October 29th. And they've made a huge rate cut, almost 100%, that will get another 25 basis points. So unless something comes out in that minutes, which I doubt, this little uprising could be over, um, unless we get a deeper pullback. Um, but we're in cheap risk for them selling, so they're going to have to flip to buying, um, and get with the program to get the market to go back up, which they absolutely could, and we could hit 7,000 by year end. Right. So once we get over 68.52, that's the go line for a long. Anything under this, you're in danger that they're going to be selling it. I was just trying to point out it's cheaper for them to sell premium, more cheaper here than it is up here, but it's not that much cheaper. It is cheaper, but it's dirt cheap down here versus, at the money right here at 68.52. So 68.25. So just be prepared for a turnaround. And it's not like everybody and their mother already knows that we need one. There's a huge amount of volume sitting at 69.41 and 69.55. So I do know that 7,000 would likely be blocked in the short term. So I don't think they'll get past 69.55 or 69.41 in the immediate future. But I think a pullback would be healthy at this point. This is looking like a reversal candle, so we could come back down and then go back for the Santa rally after that. I'm not saying this is a permanent, reversal or anything like that. I'm just saying the market gotta pull back every once in a while. You can't have all white candles every day. Not healthy. But there's nothing to get excited about at all. The other big tell about this was that NQ completely divorced from that ES trade. The ES was way over its 1 hour, or excuse me, the 1 minute range, 5 minute range, I guess 5 minute candles, way over its 5 minute range. And the NQ wasn't having anything to do with it. It never got above its 5 minute opening range. Never. It stayed under it the whole time. So that's another tell for you that that was divorced from reality. That is your sell the rip opportunity. I mean, these are the MAGA stocks, and they're already starting on their downturn. All right, guys, I'll get it together. Thank you so much. Let me know if you have any questions. And hope y'all have a good weekend, and we will see you on Monday. I do know that the market closed right where we anticipated this morning in our morning report, between 66.60 and 66.70. Once it did get off of this high, this sugar high, whatever that was happening this morning, that was divorced from reality, it went right into our balance zone, right where we thought it would be. So this, I just don't understand it. It's crazy the way that was working out, especially because the NQ was certainly not doing anything like that at all. So you can't rally the ES market with that NQ. All right.